Your traditional IRA is not a gift to your children. Not anymore. Not since a law most retirees have never heard of quietly rewrote the rules on the exact same account you have been building for 30, 40 years. Here's the situation. You've done it right. You maxed out contributions, you never touched it early, you let it compound for decades, and now you're sitting on a number that makes you proud. Maybe $400,000, maybe $700,000, maybe close to $1 million. You fill out a beneficiary form, you name your kids, and you tell yourself the hard part is done. That form takes 15 minutes to fill out. And heads up, none of this is personal advice, just general information every retiree with an IRA needs to hear. Because what happens after you sign that form is where most people get blindsided, and it involves the IRS, a 10-year clock, and a tax bill your children never saw coming. Let me introduce you to someone I'll call Walter. Walter is 72, lives outside Tucson, Arizona, in a house he and his wife paid off 11 years ago. He spent 38 years as a mechanical inspector for a utility company. He never made six figures. He just never stopped contributing, year after year, through every market dip and every recession, because that's what his father taught him about discipline. By the time he retired at 66, his traditional IRA had grown to $740,000. Walter has one daughter, Renee, 46 years old, a physical therapist in Denver, making $91,000 a year, married to a school teacher, raising two kids of her own. Walter named Renee as sole beneficiary of the IRA years ago, back when the rules were different and nobody warned him they'd changed. He thought that was the whole plan. Sign the form, done, legacy secured. Here's what Walter didn't know, and what almost nobody tells him. The day Walter passes away, the IRS starts a 10-year countdown on that account. Renee does not get to spread withdrawals across her lifetime the way children used to be able to, back when the old rules let an inheriting adult stretch payments out over 3 or 4 decades. She has exactly 10 years to empty the entire $740,000, and every single dollar she pulls out gets added to her regular income and taxed at her ordinary tax rate, right in the middle of her highest earning years, right when she's also paying for braces, a mortgage, and a car for her oldest kid. If Renee draws it down evenly, that's about $74,000 a year stacked on top of her $91,000 salary. That pushes her household income past $165,000 a year, straight into the 24% federal bracket, and depending on the year, brushing up against the edge of the 32% bracket too. Using 2026 federal brackets for a single filer, income between roughly $105,700 and $201,775 sits in the 24% bracket, and above that it jumps to 32%. Renee's added IRA income alone, layered on top of her salary, sits her right inside that 24% zone for years in a row. A chunk of the inheritance Walter spent decades building simply evaporates into federal withholding before Renee ever gets to use it for anything. And that's before Colorado's own state income tax takes its separate bite on the same dollars. Now think about this the same way with a different set of numbers, because the math scales with the account. If Walter's IRA had been $400,000 instead of $740,000, Renee's forced annual distribution would be closer to $40,000 a year, still enough, added to her $91,000 salary, to keep her solidly in the 22% federal bracket for the full 10 years, instead of dipping in and out of 24%. Smaller account, smaller damage, but the mechanism is identical. This isn't a problem only for millionaires. Any traditional IRA left to a working adult child runs into the same 10-year clock, just at a different dollar amount. Quick note before we go further, heads up, this is educational, not personalized tax advice. Talk to a CPA about your specific numbers. Now let's get into exactly why this happened, because it's not random, it's the law, and there's a paper trail. This traces back to the Secure Act, signed into law in December 2019 and effective January 1st, 2020, followed by Secure 2.0 in 2022, which added more detail on top of it. Before that law, non-spouse beneficiaries like adult children could stretch required distributions from an inherited IRA across their own life expectancy, sometimes 30 or 40 years, keeping each year's tax bite small and manageable. The Secure Act eliminated that stretch option for most beneficiaries, and replaced it with a flat 10-year rule. According to IRS Publication 590-B, most non-spouse beneficiaries, which includes the vast majority of adult children, must fully empty an inherited IRA by December 31st of the 10th year after the original owner's death. There's no more spreading it thin over a lifetime. The account has to hit zero, and the tax bill lands exactly when your child can least afford the extra income, often during their peak career years, while they're also raising kids or paying a mortgage. A small number of beneficiaries are still exempt from the 10-year rule: a surviving spouse, a minor child of the account owner until they reach adulthood, someone with a qualifying disability, or someone no more than 10 years younger than the original owner, but the vast majority of adult children fall outside every one of those categories. It's worth understanding why the old rule existed in the first place, because it wasn't an accident or a loophole. It was intentional policy for decades. Before 2020, Congress allowed the stretch, in part, as a reward for deferring taxes responsibly for a lifetime, letting families manage the eventual tax bill gradually instead of all at once. When the Secure Act passed at the end of 2019, lawmakers needed to offset the cost of other provisions in that same bill, and shortening the payout window on inherited retirement accounts was one of the ways they found new revenue. None of that made it into a headline most retirees ever saw. There was no letter mailed to IRA holders explaining the change. Your custodian didn't call you. The rule simply took effect, and it now applies quietly to every traditional IRA in the country with a named beneficiary who isn't a spouse. And it's not only the slow, even 10-year drain that catches families off guard. Sometimes it's a single bad year. Say your child inherits the account, and in year 6 or 7 of that 10-year window, they also have an unusually high income year of their own, a bonus, a home sale, a severance package. If they also happen to take a large IRA distribution in that same calendar year, all of that income stacks together and can push them into the 32% or even 35% federal bracket for those 12 months alone. A distribution that would have been manageable spread across a normal year suddenly costs tens of thousands of dollars more in tax, landing in a year when they can least absorb it. This is exactly why professionals talk about bracket management with inherited IRAs, spreading distributions deliberately across lower income years instead of letting the clock run on autopilot. Now here's where it gets important, because this affects almost every retiree watching this who has a traditional IRA, a 401k rolled into an IRA, or a 403b. Let's go through what's actually happening and, more importantly, what the IRS actually allows you to do about it, because there are legitimate legal moves available, and most retirees never use a single one of them. Let's compare Renee's situation to what would have happened under the old rules, because the contrast is the whole point. Under the pre-2020 stretch rules, Renee, at 46, could have spread required withdrawals from that same $740,000 IRA across her own life expectancy, closer to 35 or 40 years instead of 10. Her forced annual withdrawal would have been a fraction of what it is now, small enough to barely nudge her tax bracket at all in most years. The account itself would have kept compounding for decades on the portion she hadn't withdrawn yet. Same father, same discipline, same $740,000, but a completely different tax outcome for his daughter, purely because of when he passed away relative to one piece of legislation. That's the part that catches people off guard. Nothing about your savings habits changed. The rule changed underneath the account. Number 1. Understand exactly what the 10-year rule does to your family's math, because most people picture inheriting an IRA as a windfall, not a tax event. If you have $500,000 in a traditional IRA and you leave it to an adult child earning $80,000 to $100,000 a year, that child isn't inheriting $500,000. They're inheriting a 10-year forced income increase of roughly $50,000 a year, taxed as if it were salary. Depending on their existing income and state, they could lose $100,000 to $150,000 of that inheritance to federal and state income tax combined before they ever spend a dollar of it. Most retirees never run this math because the account statement shows one big number, and nobody shows them what's left after the IRS takes its cut. And where your child lives matters more than most people expect. A son or daughter in Texas, Florida, or Tennessee pays 0 state income tax on those distributions because those states don't tax ordinary income at all. The exact same child with the exact same inheritance, living in California or New York, could lose another 6% to over 10% of every distribution to state tax on top of the federal hit. If your kids live in different states, the after-tax outcome of an identical inheritance can look completely different for each of them. Now here's the part they never tell you. The 10-year rule is not the only cost. There's a second, quieter hit layered on top, and it's called IRMAA, the Income-Related Monthly Adjustment Amount. If your adult child is on Medicare, or gets close to it, while they're taking these forced distributions, that extra income can push their own future Medicare Part B and Part D premiums higher for the rest of their life. For 2026 IRMAA, surcharges kick in once a single filer's income crosses $109,000, or $218,000 for a married couple, and the standard Part B premium of $202.90 a month can roughly double or more, depending on how far over that line someone lands. It's a cliff, not a slope. $1 over the threshold, and you're paying the higher tier for the entire year, not just on the amount above it. And here's the sneaky part. IRMAA looks back 2 years. So a large IRA distribution your child takes this year doesn't hit their Medicare premium this year. It quietly shows up on their bill 2 years from now, long after they've forgotten the withdrawal that caused it. A forced IRA distribution at the wrong moment can follow your child into their own retirement without them ever connecting the dots. Number 3, and this is where you actually get some control back, the Roth conversion. Here's what it is. While you're alive, you voluntarily move money out of your traditional IRA and into a Roth IRA, paying the income tax on that conversion yourself, in a year and at a rate you choose. Here's why it matters. When your child eventually inherits a Roth IRA, the 10-year rule still applies. They still have to empty the account within 10 years, but every dollar they withdraw comes out completely free of federal income tax. 0. You've already paid the toll once, at your rate, instead of your child paying it later, at theirs, stacked on top of their own salary. The sweet spot for doing this is usually in the years after you stop earning a paycheck, but before Social Security and required minimum distributions kick in, when your own taxable income is naturally lower. A lot of retirees convert enough each year to stay inside the 22% or 24% bracket, rather than jumping to 32% in one big move. For 2026, the 24% federal bracket for a single filer runs up to roughly $201,775 of taxable income, and married couples filing jointly get roughly double that room. Someone converting inside that space, year after year, can move a large IRA balance into Roth status over 5 or 6 years without ever paying the top rates on it. This is exactly the kind of decision worth running by a CPA before you act, because the right amount depends entirely on your specific income picture, your state's tax rate, and how close you are to Medicare enrollment, since a big conversion can also trigger IRMAA on your own premiums 2 years later. Most people stop here, but don't, because there's a second tool the IRS built specifically for people your age, and it's badly underused. Number 4 is the Qualified Charitable Distribution, or QCD. Here's what it is. If you're 70 and a half or older, you're allowed to send money directly from your traditional IRA straight to a qualified charity, your church, a hospital, a scholarship fund, whatever cause you support, and that money never counts as taxable income to you at all. For 2026, the IRS allows up to $111,000 per person this way, and it can also count towards satisfying your required minimum distribution for the year. Here's why it's powerful for your family specifically. Every dollar that leaves your IRA through AQCD is a dollar your children will never have to report as income and never have to pay tax on because they never inherit it. It already went where you wanted it to go, tax-free, while you were alive to see it happen. If you already give to charity out of your checking account every year, this is almost always a better way to do it, because a check from your bank account only helps you at tax time if you itemize, and most retirees today take the standard deduction instead. One rule to remember: the check has to go directly from your IRA custodian to the charity. If the money passes through your own hands first, even briefly, it stops qualifying as a QCD and becomes a regular taxable withdrawal instead. Here's another one most seniors have never heard of because it's brand new: Number 5. The senior bonus deduction. Starting with the 2025 and 2026 tax years, there's a new deduction available specifically for taxpayers 65 and older, up to $6,000 for a single filer, or $12,000 for a married couple where both spouses qualify, on top of your regular standard deduction and the existing extra deduction for being over 65. Stack all three together and a single filer over 65 can shelter roughly $24,000 of income before a dollar is taxed. This one phases out gradually if your income is too high, starting around $75,000 for single filers and $150,000 for married couples, and disappearing completely around $175,000 and $250,000. But for a huge number of retirees living on Social Security plus modest pension or investment income, it's available in full. This deduction doesn't fix the inherited IRA problem directly, but it lowers your taxable income while you're alive, which gives you more room to do Roth conversions in a lower bracket during the same years. The two strategies work together. It's also currently scheduled to expire after the 2028 tax year unless Congress extends it, so the window to use it is not unlimited. Now here's a move for families with more complicated situations, and it takes more setup than the others. Number 6. Naming a trust instead of a person. If one of your children has a spending problem, a pending divorce, a disability, or a creditor issue, naming them directly as beneficiary means the entire inherited IRA becomes exposed to those problems the moment they receive it. Some retirees work with an estate attorney to set up what's called a see-through trust as the beneficiary instead. Done correctly, a trust like this can still qualify under IRS rules as a designated beneficiary, and it lets a trustee control the pace and timing of distributions to your child rather than handing over full access all at once. This is genuinely not a do-it-yourself project. It requires precise drafting to qualify under IRS regulations, and getting it wrong can accidentally trigger worse tax treatment, not better. If this situation sounds like your family, the phrase to bring to an estate planning attorney is, see-through trust as IRA beneficiary, and that alone will get you talking about the right thing. Now let's talk about sequencing, because this is the strategy financial professionals use constantly and almost nobody explains to regular retirees. Number 7. Spend down order. Most people assume the smart move is to leave the IRA alone as long as possible and spend down savings and brokerage accounts first. After the Secure Act, that assumption needs a second look. Every year your traditional IRA keeps growing untouched. The eventual 10-year tax bill your children face keeps growing right along with it. Meanwhile, dollars sitting in a regular taxable brokerage account often pass to your heirs with what's called a step-up in basis, meaning your children may owe little or nothing in capital gains tax if they sell those investments after inheriting them. That's a completely different and often much gentler tax outcome than a traditional IRA. Some retirees choose to draw down the IRA a bit faster in their 60s and early 70s, filling up their own lower tax brackets deliberately, while letting brokerage and Roth accounts grow untouched for their kids. Again, the right pace depends on your full financial picture, which is exactly the conversation to have with a CPA or fee-only fiduciary advisor, not a rule to copy blindly from a video. Here's the part almost every retiree skips entirely. Number 8, review your actual beneficiary forms, not what you remember writing, the actual current form on file with your IRA custodian. Beneficiary designations override your will. If you filled out that form in 2011 and never looked at it again, it may not reflect a divorce, a remarriage, a grandchild, or a change in your wishes. It also may not reflect anything about the Secure Act at all, since most of these forms were written before the rule existed. Also check whether you named a contingent beneficiary, the backup person who inherits if your first choice has already passed away. A surprising number of forms leave that line blank entirely, which can send the account through a much messier and slower probate process instead of going directly to your family. An outdated, vague, or incomplete beneficiary form is one of the most common and most fixable mistakes sitting quietly in retirement accounts across this country right now. So what should you actually do this week? Log into your IRA custodian's website, Fidelity, Vanguard, Schwab, or wherever your account sits, and pull up your current beneficiary designation page. Confirm the names, the percentages, the contingent beneficiary line, and the date it was last updated. Write down that date. If it's been more than 5 years, or if anything in your family has changed since then, a marriage, a divorce, a new grandchild, a child's financial situation shifting, that's your sign to sit down with a CPA or a fee-only fiduciary advisor and bring 3 specific questions with you. How much Roth conversion room do I have this year without jumping a bracket? Does a QCD make sense for me if I'm 70 and a half or older? And does my current beneficiary form still match what I actually want to happen? Those 3 questions, answered with your real numbers instead of a general rule of thumb, will do more for your family than anything else in this video. If this video helped you understand something about your own retirement accounts that nobody had explained before, subscribe, because that's exactly what this channel is for. Plain English breakdowns of the rules that actually affect your money, without the jargon and without the sales pitch. And if you want to go deeper on required minimum distributions and exactly when they start for you, that's the video to watch next.